Hey family, today I want us to have a look at the two infrastructure bonds, the reopened bonds that are currently on offer. Now, we don't have to be experts when it comes to bonds, but we have to have a good understanding of where we are potentially putting our money. So join me as we go through the key features of these two bonds. The government is looking for 70 billion. The purpose is funding of infrastructure projects. Now, the IFB1 2022-14 was the first infrastructure bond issued in 2022 with a maturity of 14 years, but currently has 11.8 years to go. The IFB1 2023-17 is the first infrastructure bond issued in 2023 with a 17-year maturity, but currently has 15.1 years to go. Because they were issued before, the coupon is already fixed, so this is what you'd be earning for the IFB1 2022-14. 13.9380, and for the IFB1 2023-17 you'd be earning 14.3990. This is per annum. The period of sale, this is in between where we as investor are allowed to put in our bid, is from the 23rd of January to the 12th of February. Once your bid is accepted, you have up until 17th of February to be able to make payment. When you are investing in this, you can invest in multiples of 50,000. So minimum amount is 50, but you cannot put in 65,000 or 75. It has to be in multiples of 50,000. So you can do 100, you can do 200, you can do 650, and like that. So that's a very important point to note as well. The interest payment dates are as detailed there. So for the IFB1 22-14 pays interest in this is May and November. The IFB1 2023-17 pays in March and September. Because they're infrastructure bond, they're exempt from tax, so you'll be receiving your interest in full. And the amortization redemption structure is if you invest less than $1 million shillings, then for the IFB1 2022-14 on 4th of November 2030 you will be receiving your full investment back. If you invested more, then that means you'll be receiving half of it, 50%, and then the other 50 will continue earning you interest up until maturity, which is on 27th of October 2036. I hope that's very clear. Yeah, for the IFB1 2023-17, if you invest less than $1 million, then that means on 20th of February 2023 you'll be getting your full principal back. If you invest more, then that means you'll get 50% back, and the other 50% matures on the 20th of February 2040. Yeah, this is what I was just saying, any amount, $1 million and less. When it comes to bidding for bonds, you have two ways to go about it. You can place a non-competitive bid or a competitive bid. A competitive bid basically means you are quoting the rate at which you want to lend your money to the government. For you to do so, you have to make sure that the minimum amount you're investing is $2 million. If you place a non-competitive bid, this means you are placing your money, you're lending your money to the government, and you're okay with the average rate that comes out of the auction. And for you to do so, the maximum amount that you're allowed to invest is 50 million for every CDS account. Now, the other thing that is of importance to note is the closure. So the offer closes on the 12th of February at 10 a.m. So for me, I would recommend you place your bid in by the 11th of February. Once the auction takes place and the results are out, CBK are very good. They will give you the exact amount to pay and the reference number. Please log on to your DOCSD account, check and instruct your bank to make the necessary payment. Once that is done from the 17th of February, then the bond will be available on the secondary market, which means at any particular point going forward, if you ever want to sell, you can be able to do so in the secondary market. When it comes to investing in already existing bonds, we have to factor in the accrued interest. Remember, bonds pay interest on a half-yearly basis, but interest accrues on a daily basis. Now, when we are looking at pricing the bond, then we have to take into consideration the accrued interest from the last interest payment date to when you're buying the bond. So for this, if you just use the example they've given here, if you're looking to buy this bond and you want to quote a price of 14, then that means if there was no accrued interest, then you'd be paying a price of 99,645 and 70 cents. But because of the accrued interest element, then you have to take this price and add the accrued interest, giving you a price of 103.3983, meaning now you would be paying for this bond, you'd be paying 103,398 and 30 cents, and same for the other bond. So it's very important to take that into consideration when you are budgeting on how much money you will need to pay for this bond once your bid becomes successful. I hope this breakdown helps you to invest from an informed perspective. For more insights and expert breakdowns on investing, be sure to follow our channel. If you're looking to deepen your investment knowledge, sign up for our Investing Roadmap course, where we cover topics like investing in bonds and how to craft a strong investment portfolio in greater detail. Reach out for more details. Thank you for watching and see you in the next video.